Huge economic data drop today. PCE and Core PCE, the Fed's preferred inflation gauge, are prices rising or are they cooling? Consumer spending and personal savings. Are Americans still splashing cash or are we quietly sliding further into a silent depression? Plus, Nvidia just pulled off a textbook stop loss hunt, often a great indication of a near term reversal. Is the Nvidia top in? So, first, some data that we got released today. The goods trade balance came in much worse than expected, 103 billion versus an expectation of 90 billion. Now, the reason this matters, going back to yesterday's video of the surprisingly hot real GDP or inflation adjusted gross domestic product growth rate of 3.3%. If you recall, what drove that increase or that reversal from a 0.5% contraction into this very strong 3.3% real growth rate, the reason that reversal happened was a change or reduction in imports. As we can see, the trade balance blew out ahead of tariffs. Well, that was all the front running. As soon as that front running was done, we can see it reversed. Well, this gave a boost. Remember, imports are a drag on GDP, the way it is calculated. So if you have your trade balance improve very sharply like that, it'll boost GDP just as this drew down GDP. And I had mentioned we got to wait to see how it kind of really actually ends up settling out over the next couple quarters. So if the trade balance keeps worsening, keeps decreasing, that'll be a drag on GDP. And we know that was one of the primary reasons that we got such a strong 3.3% print yesterday. Now here, I wanted to show this. This is the reason I don't show the 10-year yield relative to this way of measuring nominal growth. It is extremely noisy when you use quarterly data, but if the government is able to keep up this 3.3% growth rate, we can see the cost of the debt as measured by the 10-year yield is now 1.77% lower than our nominal growth rate. So if they are able to keep it up, they have bought themselves a little bit of time. Here is PCE and Core PCE. So this is the Fed's preferred inflation gauge. Remember, there's also CPI, Consumer Price Index, and then the PPI, Producer Price Index. Here we're looking at PCE, which is just another way of measuring inflation. This is the underlying index. This is actually how everyday Americans feel inflation. It is a cumulative rise of prices. And I wanted to point out that just in the past 25 years alone, this index or prices, as measured by the government, is up 68%. And if you measure from 2008, which is when I entered the workforce, became an adult, it is up 44%. A lot of people don't, year to year, you might feel it, but it's hard to sometimes zoom out and realize just how much prices are up in a relatively short amount of time. So here are the year-over-year numbers, and they came in exactly in line with expectations. So not much in terms of economic surprise. But what I do want to point out, core PCE is running at 2.9% annual growth rate. Core CPI is running at 3.1. PPI is above 3. So we basically have inflation running at 3, or definitely closer to 3, even if you use the headline number of 2.6, or for CPI 2.7. Even if you use the headline number, we are running closer to 3% than we are to 2%, which is the Fed's long run target. And yet the Fed is talking about interest rate cuts. So again, I think it's important to kind of zoom out and realize we are not going back to the great moderation post 2008. That era is long gone. Deglobalization, the immigration story, and the labor force, and all the various things, the fiscal and the debt that we've talked about in other videos. We are not going back to this, 1 to 2% inflation. We are stuck at a much higher level. We can see that reflected in the year-over-year data. Going back to really May of last year, for the past 12 months, we have basically been setting a new higher floor when it comes to the rate of change of the index. So remember, what this is measuring is the annual rate of change of the white line, of the red line. That is what these graphs are showing. So here's how the yield curve is responding. We can see the 30-year is up marginally, 10-year yield is up marginally. The rest of the curve is pretty much flat. We are getting a little bit more steepness in the curve. We saw a reversal of that steepener because it was quite dramatic. I think I said 15, 16 basis points. We had a bit of a pullback in that. The curve is starting to steepen again. Here is personal spending. Again, real personal spending, and personal income on a month over month basis all came in line, exactly in line with expectation. The white line shows the month over month increase in personal spending. We are running at 0.5%. Monthly data is extremely noisy. So I think it's more important to zoom out and look at a bigger picture. And that's what we're doing with the red line. This is showing an annual rate of growth in consumer spending, and it's adjusting for inflation. We have been beating this drum for a couple months now that real personal spending peaked in December 2024. We keep mentioning it for a reason. Look at how anemic this 1.5% growth in real consumer spending is. I'm putting my cursor over it so you can see, going back all the way to the early 90s, we are very rarely down at 1.5% annual growth. We know the consumers tapped out, and we'll see that illustrated in a second when we get to some of the personal savings data that we're going to look at. So personal savings was 985 billion for the month of July, and the personal savings rate, which is a rate of the disposable personal income, how much of that is going into savings? 4.4%. And this is the silent depression chart that we're going to look at in a second. Here you can see the disposable personal income percent change from the last period. So this is the month of July. We're looking at the percent increase from June. Outlays the percent change from the prior period. And then the black line represents personal savings as a share of disposable personal income. Here is a chart that Fentro and the Discord pointed out. So thank you for that. Here shows the components of what exactly is driving consumer spending. Motor vehicle and parts, a $34 billion increase. Anything in orange is a good, anything in gray is a service. We can also see financial services and insurance is a huge increase, 24 billion. This is that kind of hyper financialization of the U.S. economy. We know that we've done other videos on that concept. Housing and utilities, which again part of that kind of hyper financialized U.S. economy, showed $11 billion in growth. So to get to the savings, here is the personal savings. This is just a nominal figure. And right now, the BEA is calculating $1 trillion in personal savings. This data might be a month old, but the trend here you will see. So personal savings reflects all the money that individual average American consumers have in terms of savings. Hopefully that is clear. But you need to adjust it because the problem is that it doesn't tell the whole story. So here's personal savings as a share of disposable income. I'm going to take off the nominal figure here. This actually came in, this data is lagged by a month. This is actually 4.4%, but the trend here is hopefully very, very clear, which is as a share of disposable income, after tax income, personal savings are near record lows going all the way back to the late 1950s. Now, if this chart looks bad, it actually gets even worse. So if you look at personal savings as a share of the M2 money supply, it's actually even worse. So, this is kind of one of the consequences naturally of running such large twin deficits. By definition, when the US runs a fiscal deficit and a current account deficit, by definition, the only thing that the country kind of as a whole can accumulate is debt. This is not Japan where they are accumulating, tens of trillions in yen of national savings because they run a current account surplus. We are not running a current account surplus. We are running a current account deficit and a fiscal deficit. So the only asset that we can accumulate here in America is debt. Unfortunately, on a net basis, if you zoom way out, that is what a twin deficit nation, the only thing they can accumulate. So it doesn't really, it's not really surprising that personal savings are so poor given the kind of macro structure of the economy. So here is again kind of a nominal figure for personal income, 25.7 trillion. But I wanted to show it, I wanted to illustrate it this way because hopefully this might be a better way of visualizing the effect that inflation is having on this personal income, the red line, which shows nominal, non inflation adjusted personal income. Once you adjust for inflation, which again we know is undercounted, but even using the government's own data, we can see the wide delta between real personal income and that nominal personal income. So again, this is why it's always critical to adjust a chart. You cannot just take anything nominal at face value. Now, here's disposable income. Remember, this is left over after tax, and then you have real disposable income. So income left over after tax, adjusted for inflation. And again, it just gets worse and worse. So we can see that really real disposable income is at the same level that it was going into 2020. So this paints that story along with the personal savings rate as a share of the M2 money supply. Because remember, inflation is a monetary phenomenon. So you have to look at these kind of aggregate numbers, these nominal aggregate numbers, as a share of the total money supply. And we can see that the savings that Americans do have buy them less in terms of real purchasing power. That is why we're using the M2 denominator. Now, I'll point out that back here in the 70s and even the 80s, this was about 17% of the M2 money supply. About 17% was personal savings. About 17% of the M2 money supply was personal savings. That number now is just 5%. So a dramatic decline. Now, I'd mentioned NVIDIA. We'll finish up here. I mentioned that stop loss hunt. So, in case you're not familiar, I understand there's a lot of kind of everyday people that are not market nerds. So, I wanted to address this just as an example, educational lesson, hopefully, in one of these market phenomenon, you could call it. So, here, this dotted white line that we're looking at NVIDIA going back to late July. And this dotted white line represents the prior all-time high. Now, earnings came out on Thursday. And as soon as on Wednesday, as soon as Thursday opened up, Nvidia opened up lower. We can see that from the candle. It opened up here and ended up closing down here. But before it closed down here at 179.13, it has this crazy long topping wick. And it goes above the prior all-time high. And we can see down here, these the bars at the bottom represent volume. And we can see that Thursday, the day after earnings, that kind of initial trading, as soon as the market opened, the first trading after earnings, we can see that the volume spiked notably, going all the way back to kind of late July. This volume was basically double what it normally is for that first 2 hours of trading. The fact that it wicked above the prior all-time high and then immediately reversed, as we'll see in a second, is what is called a liquidity grab, a liquidity hunt, or a stop-loss hunt. And this is the way that kind of big institutions get in and out of positions. So here we can see the effect of that. This is a much higher resolution. We're looking at the 30-second chart. So each of these candles is 30 seconds. And what you can see is that as soon as it broke that all-time high, it triggered a ton of automatic orders. A lot of traders, whether they be individuals or firms, will place automatic stop losses or automatic purchases, right? So if you're going long and you want to get long automatically at the all-time high, because generally you break the all-time high and then you continue higher. So sometimes you will have a limit buy set up, but other times it's a limit sell. A stop loss is the technical term for that. And what happened is within the first 1 minute of trading, there was a huge amount of volume pushing the price up to break above the all-time high, trigger all of those automatic orders. And you can see that the volume that traded hands in that 1/32nd, it was 460,000 shares. And you can see what happened immediately after it broke the all-time high. it immediately dumped. And we can see down here that it dumped on high volume or above average volume. So this is what's known as a liquidity hunt. If you have, $1 billion of Nvidia shares that you are trying to sell, well, you need to find liquidity. You can't just open your Robinhood account and press sell. And it's sold in an instant. That when you have that big of a size position, if you're a bank or a hedge fund, large hedge fund, your position is so large that you can't just press market buy, market sell, and have the order get filled. You have to bring the price to a level that will trigger a huge amount of automatic orders or where there is a large amount of liquidity. And we can see that that's exactly what happened. Someone pushed the price up to trigger all those automatic orders. And as soon as that liquidity got unlocked up here, they immediately dumped on them. Whoever was buying up here, whatever kind of automatic orders got triggered to buy, those buyers ended up getting stuck with a very, very heavy bag, as we can see. It immediately dumped. And if we zoom out just to see kind of the perspective of where we're at currently, today it's showing even more weakness. So, whether or not that was a short term top is anyone's guess. But the fact that it kind of picture perfect triggered the automatic orders by breaking just above the all time high and then immediately reversing, generally you see that at a bottom or a top. The reverse can happen at a bottom. If a large player is trying to get into a position, get long, they can do the same thing, but going the opposite direction. And that kind of looks like what happened here on Wednesday, August 20th. So, anyways, hopefully that was helpful. I did, by the way, post this in the Discord. So again, anyone that wants to, I posted this yesterday, kind of right as it happened. So again, it's totally optional. It's one of those things. If you want it, it's there. You did get about a 24-hour, head start. Might have been able to get out before the dump today. It's just there if you want it. It's totally optional. We're going to continue to make the videos that we make for free. So anyways, it's just there if you want it. Hopefully this video was helpful. All the data today came in line with expectations, which is kind of strange, by the way. Generally that doesn't happen, especially with so much data. But I think, again, the bigger picture is what is important for the average American, which is, cumulative inflation is just devastating. And as is running a twin deficit as a country, because as a country running a twin deficit, we can only accumulate debt. We, by definition, can't really, on a net basis, zooming way out, we really can't accumulate assets or savings. We are a debtor nation. Is that something that we really want to be? A country that can only accumulate one thing, and that's debt. Our money is debt. And I think that, personal savings being this low, I think a lot of everyday people are starting to feel, again, that cumulative rise in prices and the destruction of the purchasing power of their wages and starting to ask some of these questions. So you can leave your comment, your thought on that question below. Anyways, hopefully it was helpful, and I will catch you on the next one.